All right, market corrections.
Yeah.
I know, kind of scary, right?
Yeah.
Even if you've been investing for a while, it's still a little nerve-wracking.
Definitely.
You know, you sent over this report, Market Corrections Explained, and it really got me thinking. So for this deep dive, let's break down what this expert's saying about the current market. You know, is this really a correction? And more importantly, what does it mean for, well, you?
Yeah. Sounds good.
The first thing that kind of jumped out at me,
Yeah.
right, is this idea that maybe the S&P 500, it looks okay fine overall.
Right.
But maybe there are some, like, underlying signs of some weakness.
Yeah, yeah.
Kind of like, you know, a house with a fancy front, but
Yeah.
the foundations are a little shaky.
Exactly, yeah.
Yeah.
And the report, it hones in on this thing, the equal-weighted S&P 500,
Okay.
which, as you know, it gives equal weight to all 500 companies.
Right.
Unlike the traditional S&P 500, which, it's really driven by how the biggest companies are doing. This one, this equal-weighted version, gives us a broader picture.
Okay.
And looking at that, right now, it's down about 8%.
Hmm.
So that suggests a wider dip across the whole market that we might miss if we just glance at it.
Right. So it's not just like a couple big companies dragging it down.
Right.
It's a bigger trend.
Exactly.
And in the report uses this analogy.
Yeah.
It says it's like a feather in the wind to describe, how hard it is to predict these corrections.
Absolutely.
It makes you wonder, can even the most seasoned investors, can they really see these coming?
Yeah. That's the tricky part, right? We have all these fancy tools, algorithms and stuff to look at market data. But, that investor sentiment, all that fear, all that optimism, it can shift so fast. It's almost impossible to predict.
Yeah, like those sudden gusts of emotion.
Yeah.
That can really just sway the market.
Completely.
Makes you wonder,
Yeah.
is it enough to just rely on those traditional strategies? Buy low, sell high.
Right.
If it's really like a feather in the wind, how can you time it?
Yeah. Yeah, it really highlights, that we need to look beyond just, what's the price doing.
Right.
This is where this idea of oversold comes in, I think.
Okay.
The report says over 90% of S&P 500 stocks
Wow.
were recently in this oversold state.
Okay, now hold on. Before we all panic,
Right.
what does that even mean? Is it as bad as it sounds?
Well, so oversold, it doesn't necessarily mean, a stock is doomed. It's more like a technical signal. It suggests that the price, it's dropped way faster than the fundamentals of the company would suggest it should. Imagine a rubber band stretched too far.
Right.
Eventually it snaps back.
Okay, so it's like the market's overreacting, pushing those prices down further than maybe they should go.
Yeah.
Based on the actual company.
Exactly. And it usually happens when, everyone gets scared,
Right.
investors start selling, and then it creates this domino effect. But here's what's interesting.
Okay.
The report, it points out there's this historical pattern.
Mm-hmm.
When you see this level of oversold, widespread,
Mm-hmm.
it often signals that a correction is ending, not beginning.
Interesting.
They even mention examples like March 23, October 23, April 24. We saw similar stuff. And every time the market, it bounced back relatively quickly.
So maybe this overselling, it's not a sign of the apocalypse.
Yeah. It's definitely something to think about. But, we can't forget these technical signals like oversold. They're just one piece of the puzzle. We can't just follow them blindly.
Right.
We have to consider the bigger picture, the economy. And that's where things get really interesting.
Okay, so let's zoom out then. What's the economic landscape looking like?
Well, the report, it stresses this point. Despite all the market jitters, there aren't really any clear signs of a recession.
Okay.
Actually, a lot of economic indicators are pretty strong.
So everyone's talking about low unemployment, strong consumer spending.
Exactly, yeah. But there's another indicator in the report I found fascinating. It's not something you hear about every day. It's called the OECD's G20 Leading Indicator.
Okay.
Basically, it tracks economic trends across all the G20 countries. And this has got this really strong correlation with, bullish market phases.
So if that indicator is going up, that could be good news for the market overall.
Yeah, it suggests that, a bear market, like a long downturn, is less likely. Of course, no single indicator is like a perfect crystal ball.
Right.
But it's definitely worth considering alongside everything else.
Okay, so we've got this overselling.
Yeah.
Which historically could be a good sign. We've got a strong economy and we've got this indicator pointing towards a bull market, but there's got to be a but. What about interest rates?
Yes.
Hmm.
The elephant in the room.
They've been all over the news lately. And everyone seems worried. What do they mean for the market?
Right. Well, rising interest rates, they definitely can affect, how the market performs. But the report makes this really important point. Their impact, it's often limited when the economy is growing, like it is now.
So it's not just this simple equation.
Right.
Rates go up, market crashes.
No, not necessarily. Sometimes those rate increases, they can actually be a sign that, people are expecting good growth.
Okay.
Think about it like this. Central banks, they raise rates to cool down an overheating economy, right? So if they're raising rates, it could mean they're confident the economy can handle it.
I see. So we can't just look at like one indicator or a headline. We have to see the whole picture, the whole economic, tapestry.
Exactly. You have to look at everything together. So if we connect everything we've talked about, this overselling, with the current economy, it might not be as bad as it seems.
Yeah. It's like that saying, the trend is your friend. If the overall trend is positive, maybe these corrections are just, small bumps in the road.
That's a great way to put it. And it brings up a really important question. Could this actually be an opportunity, a chance to solidify your current investments, or maybe even look at new ones, while everyone else is panicking?
That is the question, isn't it? It's easy to get caught up in the fear. But maybe, just maybe, there's a chance to make some smart moves here.
Yeah, it definitely makes you think. But of course, there's no one-size-fits-all answer here. Every investor, they've got to think about their own goals, their risk tolerance, right? Their own financial situation, all that.
But what I find really valuable about this deep dive is it gives us like a framework for approaching, these corrections. It's not just about reacting to headlines or, stock tickers going up and down.
Yeah, I totally agree. And the report, it really emphasizes that, that we got to understand the whole context.
Right.
It's almost like detective work.
Yeah.
You got to gather all the clues, the technical stuff, the economic stuff, and then you can make some conclusions.
And sometimes those clues might lead you to a completely different conclusion than, all the doom and gloom we see on the news all the time.
Exactly. This report, it's not saying go buy stocks right now. It's more nuanced. It's about recognizing that these corrections, they happen.
Right.
They're part of the economic cycle. And sometimes they can create some unique opportunities.
Opportunities that we might miss if we just, let fear take over.
Absolutely. It's about taking a step back, taking a deep breath, looking at the data, and then making a calculated decision based on your own circumstances, your goals.
So for someone listening right now who's, maybe a little anxious about their portfolio, what would you say is the most important takeaway from all this?
I think the key message is knowledge is power. The more you understand how these markets work, the forces behind them, the better equipped you'll be to handle the ups and downs. It's not about getting rid of risk. It's about managing it.
And it's not just about understanding the what. It's understanding the why. Why are these things happening?
Exactly. When you get the why, the fear starts to go away.
Right.
And you can make more, rational decisions. You're not just reacting, you're thinking.
So it's not about becoming, a market wizard overnight. It's about being an informed investor, thinking critically and making choices that, match your goals, your risk tolerance.
Precisely. And this report, it's a good starting point. It highlights these key indicators, like that equal-weighted S&P 500, the G20 leading indicator, and of course the overall economy. It's about having different tools to look at the situation from different angles.
It's like having a toolbox, full of different instruments to diagnose the problem, find the right solution.
Exactly. And the more tools you have, the better prepared you'll be for whatever the market throws at you.
I love that. Okay, so let's say we're going with this whole opportunity thing. What are some concrete steps someone can take to be prepared to capitalize on a potential upswing, assuming, this expert is right and this correction is winding down?
Okay, well, first step, revisit your investment strategy. Does it still align with your goals, your risk tolerance? Has anything changed in your life that might mean you need to adjust your portfolio?
Because your financial situation might be different, right?
Yeah.
Or maybe your comfort level with risk has changed since the last time you looked at it.
Right, exactly. And once you know your strategy, you can start thinking about, specific actions. Do you want to consolidate some positions? Or are there new opportunities in specific sectors or industries that you want to look into?
And that's where research comes in, right? Really digging deep into specific companies or sectors that you think might grow when the market bounces back.
Absolutely. Knowledge is key. And remember, this isn't about trying to perfectly time the market. That's impossible.
Yeah, even the experts can't do that.
Exactly. It's about being prepared, having a plan, so that when opportunity knocks, you're ready.
It's like being a smart shopper. You do your research, you know what you want, and then when there's a sale, you're ready to go.
I like that. That's a great way to think about it. Be prepared, be informed, and be ready.
So to wrap things up, I think what really struck me is that these corrections, they're scary, but they can also be a time for, reflection and maybe even, dare I say, excitement.
I think that's a great way to put it. It's a chance to reevaluate, adjust, and maybe position ourselves for future growth. It's a reminder that even with all the uncertainty, there's always opportunity for those who, are willing to look for it.
And it all starts with understanding the bigger picture, not letting fear make our decisions for us.
Absolutely. Because sometimes those scary headlines, they don't tell the whole story. There's more to it than that.
So to all our listeners out there, don't just react. Take a deep breath. Do your research. And remember, knowledge is power when it comes to investing.
Well said. And who knows, maybe this correction is the opportunity you've been waiting for.
Okay, so we talked about this big picture, right? Market corrections and how this one might actually be a chance to, to make some smart moves.
Yeah, we've gone through the indicators, the economy, even like the psychology of it all.
Right, but now it's time to actually get down to, like, what can you do?
Right, the nitty-gritty.
Yeah, what can our listeners actually do today to prepare themselves, for this potential upswing?
Well, I'd say first things first, dust off that investment strategy. The one we talked about earlier. Give it a good, hard look.
Yeah, because even if you think it's still good, it never hurts to, check, right? Make sure it still fits your goals, your risk, your whole life situation.
Exactly. Life changes, right? And your investment strategy, it needs to be able to, change with you.
So maybe that means you tweak how much you have in different assets or adjust your timeline. Maybe it means you do some more research on specific sectors or industries, ones that look, particularly promising.
And while you're doing that research, don't forget about those watch lists. The ones we talked about. If there are companies you've been kind of keeping your eye on, maybe set up some alerts.
Right, so that if the price drops even more during this correction, you'll know and you can jump on it if it makes sense for your strategy.
Yep, it's about being proactive, not reactive. Remember those sudden gusts of emotion, we talked about that. You don't want fear making your decisions for you.
Right. We're not trying to perfectly time the market because, as we've learned, that's basically impossible. Even the pros, they get it wrong sometimes.
Oh, absolutely. It's all about having a plan, a strategy, and sticking to it.
And if all this has got you curious, I really encourage you to do your own deep dive into these topics we've discussed.
Yeah, read about that equal-weighted S&P 500. Check out the OECD's G20 leading indicator. Dig into those economic reports. Don't just take our word for it.
Right. The more you learn, the more, I think, confident you'll feel about navigating these, market ups and downs.
Yeah.
And hey, if you find anything interesting, any insights, any questions, let us know.
Yeah, absolutely. We're all in this together, right? Trying to build a community of informed investors.
Exactly. So keep those brains buzzing, keep those portfolios balanced, and until next time, happy investing, everyone.
Happy investing.